So in today's podcast episode, we have another portfolio analysis review. We actually take Richard and Ilona's portfolio, they've plugged it into the Property Llama software, and we do a full deep dive into opportunities on their portfolio. If you listened to Ben's portfolio analysis last week, it's the same drill this week. We're just going through a different portfolio, and this was more acquired through an investor landlord hat versus a house hacking acquisition method. So on the panel is myself, Joe Massey, Chelsea Scott, and then Richard and Ilona in the hot seat talk about their portfolio. So I hope you enjoyed this show. It was phenomenal. Their reactions were fantastic for the opportunities they had in their portfolio. So please enjoy it. And of course, if you have questions or you're confused on what to do with your portfolio, go to the website, fill out the investment consultation form. We'll take care of you. We'll plug your properties in the software and help you do a full analysis as to what opportunities that you have and help you make the best plan for your portfolio. Enjoy the show. So shifting gears into here is going through Richard and Ilona's portfolio. Originally, we had this set for last week, but we went really deep with Ben's portfolio and decided to push this into this week because I think Ben's portfolio was very representative of people house hacking, and Richard and Ilona's portfolio is very representative of landlords. So a great one to look at here.
Cool.
And Richard, I know, I think if I recall, Ilona was kind of prodding you a few weeks ago to actually put the properties in the software.
Yeah.
And you did. And I wish I recorded the reaction of when you actually put it in there. What was your reaction?
Well, my reaction is that my portfolio, in terms of its current day performance and all the metrics we look at, was a lot worse than I was expecting. Except, the silver lining to that is that it's because they've all just appreciated so much. So, well...
You were much more animated. You're
Yeah,
giving the logical, rational
I couldn't
answer
believe
now,
it. Yeah.
But you were more like, you were very animated. It was hilarious. I wish we had a recording of that. All right, so jumping into here, I did the same thing like with Ben's portfolio, and we can look at the very high level. So this is their current portfolio, which is made up of 3 properties, right?
Yeah, 3.
Give us just a high-level overview of them.
Okay. So we have kind of an interesting story here, as I was alluding to earlier, So we lived in Hong Kong a few years ago. We've only recently moved here, except we've been investing in Colorado for a couple years now, or I'd say like a year and a half. And so where this started was that we were planning our move back here. We knew it was on the radar. We were applying for visas, and it's a long process. And actually what we did was we purchased a single family home that we intended to live in, even though we weren't going to move for several years. And so that kind of was the very first property, and then we were hooked because...
And you purchased it as an investment, right?
Well, I mean, we were going to tenant it. Yeah. We said we're going to put the money in the market. We have the cash to make the down payment. Mm-hmm. Colorado has very strong appreciation, especially Denver, especially Highlands Ranch, where it's located. And so we said, yeah, we'll buy it now, and then we'll get to ride some appreciation and, cash flow from the tenant and everything else, and that'll be nice. And then we'll eventually move into it. So after that, I would say we were pretty hooked because within a month, I think we started the search for the second property because at that time, the market was really vertical. Mm-hmm. I mean, we made 50% on our down payment within a few months, honestly.
Is that about a year ago you bought the second place?
It was September 20 that we actually...
Okay, a year and a half ago.
It was 6 months later.
Okay.
Yeah, I mean, so I think that we started our search second quarter 2020. We got it closed third quarter of 2020. And then even before the end of the year, like I said, the thing had gone up in value 10, 15%, which in relationship to our down payment was like this massive return. And we were like, wow, let's do this some more. And then so we acquired a second property, in Colorado Springs, which we took down under, conventional terms. And this one would have also been, more standard. Like this one was chosen as an investment property. We tenanted it. We took it down with a mortgage, very standard stuff. And then we actually would have kept going, except from what I understand, and actually I did talk to you, Joe, is that basically banks stopped lending on people with overseas income, which we had.
Mm-hmm. It's difficult.
Yeah. I mean, it was already difficult. And then it just kind of got to the point where people were like, just wait until you get back, And so then we got back a few weeks ago, 4 or 5 weeks ago. And then I identified on a visit to my Colorado Springs property, ran into an agent about to list the next place. She quoted me the price. I knew the price was literally what I paid over a year ago. So I was like, I think Colorado Springs has seen some appreciation, and I just said, you don't need to list this, you don't need to paint it, you can sell this to me today. And I was like, and you can double in the commission, because
that right there is a tip that everyone that's complaining about the market should learn. Giving the listing agent, the opportunity to double end it, all of a sudden you rise to the top of the VIP list.
Well, it never made it to the MLS.
That's right.
Basically, she's like, are you okay with this price? And then I'm doing my like poker face, and I'm like, well, I see you were going to do some renovations, so how about you give me a discount for half of what you were going to spend on the renovations?
They're like, oh, okay.
Yeah. And she's like, I think that's fair. And I was like, then you don't have to mess with it. I was like, I'll close quick. I mean, and I just moved here, so I still didn't have a loan figured out. So we actually closed with cash on that one. And we're in the process of trying to, convert that into pull the cash back out under a mortgage, and we'll get more to that later. But I think that
was a great summary.
That's
awesome. So that's the stage there. So single family residence in Highlands Ranch, investment bought for a future primary, 2 townhomes down in Colorado Springs. So currently about $1.2 million.
And they're identical since it's
the townhomes.
Yeah. It's worth mentioning that they're identical. Like it's literally in the same unit. So for all practical purposes, it's the same.
So about $1.2 million total valuation. About $700,000 in total equity. Now going to loan to value and the 3 metrics we really look at right now, it's a 43% loan to value, which is below that 50% rule of thumb we established. A 3.2% portfolio-wide cash on cash, a 3.6% average cap rate, which is below the 4%. And then return on equity, I don't have it on this one. Anyway, low LTV, low average cap rate, and I can tell you return equity is low as well.
It's like 5 or 6.
Yeah, since you have a property in cash and a highly appreciated residence.
I actually deleted it off this because I didn't want to embarrass Richard.
Yeah. It's like a 5. Honestly, it's pretty bad.
All right, so that's the current snapshot of the portfolio here. And going into property number 1, this is a single family home in Highlands Ranch. And you can see here, it's a very low cap rate and very low ROE. It's a 6% return equity using the formula that I talked about last week, and about a 53% loan to value with a 2.9% cap rate.
And I think it's worth adding to this is that we intend to house hack next anyways. So it's not like we're even ready to move into this. Like this thing is on the back burner for still another couple years, even if we were to hold on to it. That's worth mentioning.
And I have notes here. I'm not a fan of mixing personal investing because what's going through you right now is often what people go through.
Yeah, I entered the property and I was like, oh, this is bad.
What's your thoughts on, Joe, people buying an investment property, turn their primary residence in 2 or 3 years? Do you see it happen very often?
No, not frequently.
A lot of people talk about it, but very few follow through with it, right?
Very few people do it. Yeah, very few. I see the opposite. I'm going to buy my primary residence, 18 months, 24 months later, I'm going to move out and turn that property into a rental. I very rarely see somebody buy an investment and then in the future move into it.
Yeah, I mean, I was like 9,000 miles away.
Oh, yeah.
No, we get it. We're not being critical.
No, I'm just saying there were like special circumstances which explain, this type of action. Absolutely.
And the reason I don't recommend it is because a lot of times it doesn't work out. Like in your situation, things change, which is perfectly fine. The other reason is it's very hard to find like a property that makes sense now. And also be like, oh, this is my dream home or close to my dream home in 3 years I'm going to move into. It's very hard to balance those two. Mm-hmm. But regardless, you've got $300,000 in change in equity. So you have some opportunity there in your real estate piggy bank. So property 1. Lots of opportunity there, and we'll explore a cash out refi or sell and trade up. And this is townhome number 2.
The normal one.
The one you bought a year ago. This is the only finance.
Yeah, the only like normal property in the portfolio is that
one. 4.8 or 4.7 cap rate, 10% ROE, and a 50% or greater than 50% LTV. So it meets the metric. And 2 things I'll point out here is that you are self-managing this with these numbers here, if I recall, right?
We've just transitioned to self-managing.
And so, if you were to put a PM fee in here, you'd probably be right around like a 4% cap rate or so.
Yeah.
So if you self-manage or hire a property manager, you may want to adjust the cap rate accordingly because a lot of times that's a 0.7, 0.8 cap rate bump is what I see, Joe.
Yeah, it depends on the rents, right? But yes, it definitely impacts it negatively.
But regardless, right here, like you're kind of above all those metrics. You have about $100,000 in equity. So like a good amount, but also not like a huge amount.
Yeah, correct.
So unless there's like a huge opportunity, I'd kind of sit and hang tight in here because this is a very good property and just let it appreciate from the year or two.
Yeah, and Colorado Springs is a great area, especially
yeah.
like this property is right by a major like industrial revitalization area too. So I would say that, like that's something that doesn't appear on the spreadsheet, which would help justify a hold because I believe I'll see outsized returns in the appreciation category.
Yeah, you're also getting great rent for a 2-bed.
Yeah.
Here, looks really good.
So moving on to property 3, which is the identical townhome, same complex that you guys closed on a couple weeks ago with cash.
On the 24th, yeah.
Okay, yeah. So literally, 2 weeks ago. And originally, I remember we were talking about this offline. Is you said, hey, you bought it for like $217.
Yes.
And it's worth about what, $260?
$257 around there.
Yeah.
You know.
So at least $260 now. It's been a couple weeks. It's already appreciated. So
yeah, that's right.
And you talked about potentially just doing a quick flip on there because that's an easy $50,000 in equity right there potentially.
Well, and because property managed it's only a 4. So I was like, maybe just take the cash.
Here's the problem I don't like with that is even if you flip it, that's basically the same as a property flip with no cosmetic remodels. You're going to get hammered with taxes. You're going to get income taxes and short-term capital gains taxes. And a lot of times, paying with tax bracket, you're like 40 or 50% all in to the government when you pay income tax, state tax, self-employment, FICA tax on there.
So that leaves like 20 grand, and that was a lot of work for 20 grand.
Yeah. Is that worth it then?
And a lot of risk too.
Yeah,
I went in all cash on it.
Right.
So what I like here instead, and this is what a lot of times we coach our clients into, is buy the property, put a renter in there for 1 year, and if it makes sense, then flip it, almost like a delayed flip, because now you went from short-term capital gains to long-term capital gains, and now you can 1031 the property and defer your taxes and depreciation recapture.
And there'll be a bit more appreciation between now and then.
Right.
Now, if this was like a 2% cap rate, that's a different story, but you're borderline here, I would keep it.
Okay.
But here's what's interesting. Because this is a property you bought cash. It's a 4.5% return equity. So incredibly low return equity, which is the same as a cap rate.
Right. When you pay cash, your return on equity will be the same as your cap rate.
Exactly. So with this, that's a horrible cap rate and just a very poor use of equity. So
yeah, but the refinance is in progress.
No, so I'm saying to buy. I'm saying just hold it in cash. Like some people, this is why you don't buy it in cash.
Yeah,
that's what I was trying to say. Don't buy it in cash because it's a very poor use of money. Like leverage loans and real estate is how you make these big returns, and we got to leverage up.
Yeah, totally.
So I know this. We started checking about this before, but Joe, they bought this on the 24th. We are on February 8th. They bought it cash. What options do they have for putting financing on here?
Well, especially because here's the concern that we discussed earlier is that, because I paid $217, the default would be that I would cash out. We'll do a delayed finance is that I'd receive basically the valuation of the $217 that I paid for. Needless to say, it would be preferable to me to be able to do a cash out at the 255-ish, 260, because then, hopefully I would it would be almost a burr.
So can I ask you some questions?
Sure.
So I know you said the property needed a little bit of renovation. Have you done any work to it? What have you done? Have you put a tenant in there? What have you done with it?
There is a tenant in there, and it received the carpet upstairs, and it just needs patch and paint, so it'll be ready in like a week and a half.
Okay, great. So you did a little bit of sprucing up.
Yeah.
So here's the way delayed financing works: is you paid $217 for this property.
Yeah.
You can take out up to 75% of the new appraised value, not to exceed what you paid for the property. All right. And so when we talk about the new appraised value, one of the first questions the appraiser is going to ask you, hey, you just paid $217. Have you done any work? All right. Yes, we've done paint, carpet, we've fixed the furnace. We've done whatever we've done.
Yeah.
Okay. We've spruced it up. We've put in a tenant. And here's all my comparables, Mr. Appraiser, because this is one really important point. You're the homeowner. So you can provide your background, your backup for these are the comparables we've used. This is the other property that we have here in the area. This is what we think it's worth. Now, Mr. Appraiser, of course, you're going to go out and you're going to complete your valuation. But the appraiser's job is to appraise the fair market value of the property. Mm-hmm. Okay. Their job is not to say you just paid $217, so it's worth $217, right? Nothing would ever appreciate. They're supposed to say, hey, you paid $217, you've done a little bit of work, that moves the condition up. What are other similar condition properties selling for? So now let's say, I did have to pull out my calculator so you guys don't make fun of me for my math skills. So let's say the property appraises for $257.
Okay.
All right.
Yeah.
You can take out up to 75%, which would be $192,000. Now, if there's going to be costs associated with that, let's call it $5,000 in closing costs. You're going to get back, $188,000, $187,000. So you're going to be into this property for about $25,000, $30,000. All right, depending on how much your renovation costs are. Now, let's do the math, and let's just say, for argument's sake, the property appraises for $300,000. All right, not likely, but let's say that it does. If the property appraises for $300,000, you can take out 75% of that new appraised value, which would be $225,000.
Mm-hmm.
Now, you can't take out $225,000 because you only paid $217,000 for it, but I could give you $217,000 in cash, and then we can use that difference of $8,000 as closing costs to maybe buy down your interest rate. All right. So the catch is, we're going to ask for that settlement statement when you bought it. You can't get cash back of $217,001, but you can get back $217,000 exactly, and that difference we could use to pay all the closing costs, and if there's excess, use it to buy down your interest rate.
Interesting.
Yeah, and so that's assuming the property appraises for $300,000, which is a stretch.
Yeah.
But the important point that I want everybody to understand is you can take cash out based on what is that new appraised value, as long as you're not taking out more cash than you paid.
Well, so Joe knows this because I just got your home bought emails.
Yeah.
Thank you so much.
You're welcome. I hope you like it.
Yeah. And you and I have done delayed financing many times.
Yep.
And so if that scenario had happened where it was worth $300,000, which one of my houses that you financed for me, it did happen to.
Mm-hmm.
And if I'd waited that amount of time to finance, you basically just got every single dollar that you paid for this in cash back to you. I mean,
that's the goal, right?
I mean, and money is still cheap. Like, I can't say that enough. I mean, 4.5% is still really cheap to borrow money.
Yes.
And so you just literally got all your money back at a very inexpensive cost in that scenario. Now, and it can happen because it happened to me.
Yeah, that's right.
I think it's important to know that I think that for delayed financing, it's allowed only like 60 days. Or something like this to do
6 months.
6 months.
Yep.
Oh,
6 months. Yeah. So this is an important point. You can take the cash back out within that 6 month period. After 6 months, then it's just a regular cash out refinance and there's no restriction. So a real good example I'll give you, I had one of my clients, similar situation. They paid let's call it $217,000. We got the appraisal back. They did a bunch of renovations and we got the appraisal back. It was like month 5 because they had to renovate the property. It took a lot of time. The property came in at like $400,000. All right. I could have given them a delayed financing loan of $225,000, but they would have still had a ton of equity. Instead, we just waited until they owned the property for 6 months and 1 day. And then we were able to give them a loan of $300,000. So we got back all the cash he paid for it, plus additional cash. And so that happens sometimes if you're right in that 6 month, 4 month, 5 month, 6 month window, it might make sense to wait. But you don't have to wait to get the appraisal. You just have to wait to close.
And that's why you want to have this conversation, because you literally just doubled your leverage. Like you leveraged up double, 2x in like the course of 6 months. So you had $200,000 here. Now you have $400,000 6 months later.
Yep. It was $300,000 because there still needed to be some equity in the home.
Even 300, but I'm saying the point, like if I'm back to Richard's
massive
scenario,
impact
is like you only had $200,000 to invest 6 months ago. Now you have $400,000. You got your $200 back. Now do it again, right? I mean, that is like such incredible leverage.
Yeah, absolutely.
I mean, I would consider it, even if we're able to refi at this like 255, 260, I would still call that a huge win. Being able to pull half my cash out in a matter of weeks.
Yeah. You'll be into it for your cost of your renovation, $20,000, $25,000, maybe $30,000, right? If you've got $200,000 and every time you do this, it costs you $30,000 that comes out, you can do this, 7 or 8 times and build your portfolio just recycling the same $200,000.
And it's such a great argument to how to build your equity in an appreciating market and how to like double your buying power, triple, quadruple, keep doing it over and over. So if you're in a highly appreciating market like we are now, look at what you can do to like stretch this out by doing this over and over again.
I agree.
And you were able to do this for me quickly. I mean, we just churned and burned like 1, 2, 3. So it's not like there were a lot of roadblocks.
Yeah.
How many weeks does this
that
take?
process?
3 weeks.
Whoa.
Yeah.
All right.
Yeah. Like I'll give you a real good example. Chelsea, we knew we were going to do this. I couldn't actually start on the transaction because she has to own the property, right? You can't apply. So she went to the closing, purchased, paid cash. and then swings by my office that afternoon, signs the application, we order the appraisal, we close 3 weeks later.
Yep.
And so in your case, you already own it, so you could start the application whenever you're ready, but it doesn't take very long.
And I will say it's the fewest words I've ever exchanged with somebody professionally. It was like, how much, when, where, sign, good, done, have a good day.
I was like, see you later.
It was such an easy
That's what
process.
I'd actually been told before that the delayed finance is actually a significantly easier mortgage than when you're trying to mortgage during the close. Because the way it was described by, I'm talking to another mortgage broker, and I'm glad I talked to you as well, is that he's like, there's no deadlines, there's nothing like this. It all happens at our own pace.
Mhm.
It's not like you're trying to do that on top of 9 other things and that, you know, there's an order of operations. None of that. We can take it at our pace, and then it closes when it closes.
Yep, that's very true. But when you say our pace, my pace is really fast because I want you to get the money back.
Yeah.
So that you can then buy the next property.
Yeah. Ideally, but it's not. Well, and also like there's no risk of like the deal falling apart
Right.
because
You already have it.
Yeah. I've already got the property, so.
Yep.
Yeah.
Cool.
So,
And then-
go
Sorry,
ahead.
and I guess then moving the property back to LLC, which was what we are trying to do, that all happens after this delayed
Correct.
financing is handled.
Yep, because the property needs to be in your personal name when you buy it,
Mhm.
in your personal name when you refinance it. After that, you can transfer it to the LLC. I know we've done podcasts and everything on that. Everybody that's on the call today understands the pros and cons of that, but that would occur after you've done the new loan with us.
Right. So basically, we gotta manage during this time we're managing the risk.
Yeah.
Because the tenant is there, and we are trying to make it so that
Yep. Just make sure you have a big umbrella policy.
Yep.
That'll solve everything.
we did that.
Yep. Perfect.
Okay.
So one thing I want to say about, I'm actually posting this to Facebook right now. This podcast that Joe and I and the lawyer did for transferring a property to an LLC. Since this is like one of the most favorite questions of investors out there. If you're not sure how that works and the pros and cons, check out that. Post it in the, well, we'll make sure it's in there. So one thing I'll comment on here is before we go to the next property analysis or portfolio analysis is that if you do want to do delayed financing or cash out refi, I would definitely recommend that you talk with Joe or talk with your lender before you even buy the property, because I've heard horror stories from investors. I've heard horror stories from Joe where people buy a property and say, oh, hey, Joe, I want to do financing on here. It's like, oh, well, you know what? You should have talked to me 3 weeks ago. So you should have done this, this, and this.
That's right.
Now we can't do it. So talk sooner, not later on here, and don't assume anything, because assumptions make an ass out of you and me. I think that's how it goes, right?
Yes.
Mhm.
That's what
I've
assumptions do.
I've heard that. Yeah.
Yes, and I've done that too. So don't do that. So going back to the slides here. Now looking at the portfolio optimization. So here's some of my bullet points, and then Joe and Chelsea, I want you guys to chime in. What stood out to me was to sell and 1031 your Highlands Ranch property, because you're going to be $300,000 plus in proceeds, and it's just a very poor performing rental because you saw huge appreciation.
And it loses cash on cash. It's negative cash flowing.
Yeah, and that's yeah.
Your GRM is terrible,
Yeah.
right? Your GRM is not very good.
And I would personally do a cash out refinance or delayed finance, whatever, on the condo.
The second one.
The second one. And hold both condos. I mean, they're borderline right there as far as numbers, but here's where it comes into play. And we talked about this, Ben, I think it was Ben's podcast last week, was that you're already talking about potentially selling one property and putting $3,000 or $4,000 into another property. That's a big freaking move. Now, Highlands Ranch is a very obvious thing to do. If there's an amazing opportunity or you're good with more moving parts, you could potentially trade up the condo, or I should say townhomes. But from like an emotional standpoint and like risk mitigation standpoint, I would do Highlands Ranch, hold the condos for a year or two, especially since one would be, short-term capital gains, and then do 1031, get a feel for bigger multifamily, and then see how you like it. And
Yeah.
I would trade up into a multifamily.
Plus, I have very high conviction on those properties in Colorado Springs right now. I mean, even if the cap rate's low, you look at the historical performance of Highlands Ranch, of Colorado Springs in the past few years, as well as that's not expected to change. I mean, I think that holding on to those for another 2 or 3 years, we'll see some pretty good returns, without having to do like all the work and all the brain damage.
Yeah,
and-
ride the wave.
Yeah.
And they're recent purchases, so you probably want to hold on to them.
And I just put a lot of work into them.
Yeah. So I agree broadly with everything you said. Just a couple little things. So I think you're negatively cash flowing that Highlands Ranch property as it is right now.
That's sort of like if you account for maintenance and all these other capital
like
accounts
little
that
things.
on a month-to-month
Back when
basis,
money.
it does cover the mortgage because I haven't had any big maintenance items yet.
Okay. Oh, perfect.
But about
Well,
negative $100 a month.
Yeah,
with
it's
under
not
there.
bleeding
so
cash.
It's
It's
not
not.
a huge deal,
Yeah.
but I just think
Yeah.
that adds to the argument as to, if it's a struggle to get it to break even or cash flow well for you, with that amount of equity in there and some of the other opportunities you're seeing now out there, I would agree with that comment. Seller 1031, that one for sure.
And plus, I did and I think it's worth doing a callback
Mhm.
to what we sort of discussed in the first few episodes, which is where's your risk tolerance and what kind of investor are you?
Yes.
And
Yep.
mine is relatively high, and I would also consider myself, I want to make big moves. That's what I want to do.
So, and I think that's a great
Right.
point. Yeah,
Yeah.
it totally ties back to the our first conversation. And yeah, you want to make big sweeping moves, that definitely ups your risk. So that's great. So yeah, I would probably 1031 it though, in terms of the dollar cost averaging that we're talking about here. But that would be my choice.
I mean, so he was one other thing. Like he was saying, your reaction when you put the properties in. So as I recall, once I saw the results of that one, I was like, sell everything.
Right. Just get out.
Sell. Yeah.
Yep. Okay. So perfect. So then that lines up with your thoughts too. So awesome. I think the second condo that you have is pulling in lower rent than the first, and I was just wondering, slightly.
That might be
It's so
data entry
slight.
issues.
Okay,
Don't
so
worry.
they're both. So I was going to say maybe up the rent a little when you're on the cash out refi. I was just going
Yeah.
to think of that one. Otherwise, the $2 million. So I just want to point this out. I'm sure people probably know this, but that's the 25% down on $500,000 that Chris is calculating there. So he's saying 200,000 on the cash out refi, and the 300,000, that's 500,000. That's 25% down payment on a $2 million piece of multifamily.
Yes.
Yeah, I
Thank
follow.
you.
Yeah, but good to spell it
So,
out.
I mean, just to kind of, spell that out. But I would totally agree. If your goal is up to $2 million of multi, I mean, I love that point. Every single time I love that point when people realize what 25% down is, because they're like, wow, I can have $2 million.
That's a serious building.
That's just, I mean, in terms
Yeah.
of the back to the
Yeah.
back to the goals that we started with, like
Yeah.
talk about pushing you up in terms of valuation goals.
And plus, it's like, here's the thing. I want to move into multifamily. It's a different game and a different skill set. And that everything I've read about, people in my situation who own SFRs and stuff like that, and they're like aspiring someday to move into multifamily. The advice that I see over and over again is just do it now, because once you've changed games, now I'm playing the multifamily game permanently, and that is a much larger game with much more substantial returns and business opportunities and all the other kind of things that you just can't
Cool.
find in SFRs.
Yeah. Cool.
Joe, any comments on their portfolio?
The only thought that I have, I definitely think taking cash out of the condo. The tricky thing on the Highlands Ranch property, I do agree with selling that and 1031ing into something else. But it might also be worth doing a home equity line of credit or taking cash out of that, which I know is going to impact the cash flow. And buying one or two additional condos right now and let that Highlands Ranch property continue to appreciate, because it is appreciating significantly.
Yeah.
And if we don't have something to replace it with right now, it might make sense to just take cash out, leave it there, because the property is going to appreciate regardless of the type of
Just
loan. you have on
relevering
it.
though.
Yeah, lever up on it, buy one or two other condos. Then maybe at some point in the future, maybe a year down the road, when we're going to sell one or two of these condos, then we're going to sell that Highlands Ranch property. And I don't know if that's the right answer, just an alternative.
Yeah.
And I think it's important to know that don't make changes all at once, right? So we will probably do the cash out refi condo first, so delayed financing on that, and then wait a little bit,
That's already in
and then
progress.
do the cash out refi probably in Highlands Range, let it appreciate along.
You don't want to sell.
Because we have two. Okay, here is another thing. We do have two more off-market deals within the same
We don't know
within the
We
same
have prospects.
building complex. So we are just still in the negotiations and stuff like this. So that will just let us buy more, basically properties within that building complex.
to flesh that out a little bit, word has gotten around at the complex that we're acquiring.
That you're the big fish in town?
Yeah. And so we've been made aware of like 3 total units that want to go for sale, and if they're willing to sell them to me at the same price,
You should buy them.
yeah, I should buy them, because that's like free money. You make the money when you buy. I mean, that's substantial improvements to my long-term returns on, I have a limited pool of capital to deploy here at the end of the day. But I would put those like we have not received pricing on those. Like that is such an early stage thing. But I would agree if we get offered 2 more units at 215,
You got it.
I'm going them. Yeah, I'm doing them. So
And the other thing you look at there is this is where, like I know we'll have Travis Spear on here in a couple of weeks, and he does more creative financing on here. Is like this is where while you're doing all these, I would start talking to lending. Like you got Joey here for residential. Talk to Travis for like non-bank creative financing. Talk to some commercial brokers and start understanding the financing for all of these.
yeah,
Because a lot of times you can layer it on there. I know Joe has done numerous deals with Travis, other hard money lenders around town where they give them the short-term money to buy the property.
it's like mezzanine
then-
finance.
Yeah, and then Joe
Basically,
takes the
that's-
takeout
yeah,
financing.
Yeah, it's
Yep,
mezzanine.
that's exactly what it
So I
is.
would be very
Yeah.
much on like talking with the lenders and picking their brains and getting their game plans on there because they're all going to have different products and say, hey, think about this. You're like, oh yeah, it's a great idea.
Yeah, I mean, I'm hoping that I don't have to be so aggressive. Like, it's not like I was aggressive with this close because I had to win the deal, and that's why I did cash in 15 days. It was because I had no other lending. It was like my 3rd day in the country,
Mhm.
you know. And so
Yeah.
I was like, I'm not going to let this deal go because I heard the price, and like, look, here's my theory on why it's worth more. That's what I paid for it a year ago, same
Right.
price, and I know for a fact that the area has it is appreciated 20%.
Right.
That's my thesis.
You got a 20% deal just by
Yeah,
waiting.
Yeah, which represents the majority of my down payment.
Mm-hmm.
And that's where if you can buy at a discount like that, it may make sense to delay trading up while you recycle your
Yeah, because
capital.
that's just a crazy opportunity. Yeah.
Yeah.
So what I'm hoping that if what I'm going to propose, and this is like a lot of ifs, is that if I can get these at a discount, I'm just going to try to close them normally.
Yeah.
Like without having to get creative. Because, I mean, apparently I'm the one with the initiative here because it's not on the market yet. So, you know, my choice would be, and I think for obvious reasons, to try and close the further 2 properties conventionally.
Can I play devil's advocate for a minute?
I would love feedback on that. Yeah.
So let's go with our same numbers. Let's say you're going to buy the property for $217.
Yeah.
All right. And you call me and say, hey, Joe, I got to,
Oh, because then I can't cash out more.
right. But hold on, I got to connect all the dots for everybody else. So you're going to buy the property for $217 and you call me and say, hey, Joe, I've got a 21-day contract. I want a regular loan. Okay, great. We're going to do 25% down of $217. So you're getting a loan of, what's that, $160.
Yeah.
All right.
That's what I did last time.
Yeah, you get a loan of $160. You've got 25% down.
60.
After you close, the property's worth $257 because that's what we've got other comparables
So I have
for.
$100K in equity. In the
Now you have
property.
$100K in equity, and then we're going to make fun of you in 2 months when we do this
'Cause
again,
it's
and
the
your,
same
and your
thing.
return on equity sucks.
Yeah, right.
So let's cash
This
out
is a
refi
great
Highlands
point.
range.
Yes, you should cash out refinance Highlands Ranch
Oh,
and use that
to
cash
execute.
to
All right.
purchase the other ones. Mm-hmm.
Yeah.
And this is why you talk to a lender before you make
This is
the
why
move.
you join a mastermind.
Not
a
lender, the lender.
The lender, yeah, sorry.
Yeah. Wow.
The gloat.
No, this is why, yeah.
Yeah, the gloat. The greatest lender of all time. That was an offline reference.
All right, so keeping an eye on the clock here and being mindful of time, I want to go through and show the portfolio example here.
Sure.
And going back to recap, this is saying you sell in 1031 Highlands Ranch.
Okay.
And you take $300,000 in proceeds, and you do your cash out refi or delayed financing of your Colorado Springs townhome at about $500,000 in proceeds. So that is, as Chelsea said, a 25% down payment on a $2 million property. And my assumption is this is around a 5% cap rate property that includes property management in Denver or Springs. It might be slightly lower, but this will definitely ballpark the idea. So that top quadrant or the top portfolio is the existing one. The bottom one is with what I said, sell Highlands Ranch, refi townhome number 2, and then take $500,000 and put it into a $2 million multifamily. So here's it gets really cool. Look at the upper end of the slides here. Your loan to value goes from about 43% to 74%. So a huge change, like 30% LTV. Your cash on cash return actually drops from 3.2% to 2.7%. So a slight negative change there on the return.
And to review, I don't value cash on cash currently. That cash flow is not a high value thing.
That's
for me
not
at
a
the
metric
moment.
that you're concerned with.
Not at the
Yeah.
moment.
Perfectly
Perfect.
fair.
Yeah.
Love
Yeah,
it.
yeah.
That fits in really well with this analysis. So
And
Great.
it's also the reality of the market where we're seeing you're buying into raising interest rate or rising interest rates. But while the cash on cash goes down, your total cash flow actually goes up from about $13,000 to about $18,000. So you actually do see higher cash flow. Your cap rate goes from about 3.6 to just under a 5% cap rate. Here is where it gets really, I'll say, jaw dropping.
Yeah.
Your NOI goes from about 45,000 to about 125,000. Your net operating income.
basically.
Yeah.
Yeah, your NOI triples.
Yeah.
Your valuation, like your total portfolio valuation, goes from about 1.2 to 2.5. It basically doubles.
Whew.
Mhm.
Whoa.
Yeah.
And actually, I have my real goals, by the way, in these portfolios. And
Oh,
you
talk
can-
about those for a second, because I
yeah.
did match them up on here.
Yeah. And so luckily I know what these say, even if so the top one is portfolio valuation. And I actually came up with these numbers. I was thoughtful about it. It's not like these numbers are correlated either. It's not like I took a spreadsheet and said, if I'm out of this cap, then it must, they're kind of intuitive numbers. So I said I wanted 4 million in valuation, and I would say these are medium term goals. These aren't like
Forever.
in a million years I need this much. Like, I want to hit these goals. I'm aggressively working towards them. And then the second one, I want a total equity of, I think I have 1.25 million. Yeah. And yeah, those are the main ones. And then NOI, oh, that's a massive one, is I wanted 250,000 in NOI. Because that's my forward looking metric in the future of, I want like the 20,000 free cash flow when I retire. So,
but if you're aggressively making these moves, one move gets you pretty much halfway,
exactly,
more than halfway to your valuation.
Yeah, this is a crazy amount of
halfway to your
progress.
NOI. Yeah,
This is the power of adapting to the market rather than, to be quite frank, like whining and moaning about the Denver market and the reduced cash flow, which it is right now. So is Spring, so is Pueblo, so is everywhere across the country that's a decent market to invest in. You say, hey, the market gifted me appreciation.
No, it's crazy. We've had like
100,000,
200,000 a year, and like that's massive.
Yeah.
Right. Right. And here's the thing. That's going to happen whether you're involved in the market or not. You might as well be involved. Right? It's going to happen to whoever owns that property. It might as well be.
And it'll be more impactful if I have higher leverage.
That's right.
Yeah.
So I see a couple great questions on here I want to go through real fast, guys. I want to cover Ben's action plan in about a couple minutes. So great comment here from someone on Facebook, Richard and Ilona. That's awesome that you want to jump into commercial. However, with residential mortgages getting the lowest 30-year debt versus short-term adjustable rate mortgages, 3 to 10 years in commercial, if you still can get residential financing, why not go after 10 residential properties to at least take advantage of that so you can still get long-term good returns, long-term lower interest rate?
I think this is a fantastic question because I spend a lot of time thinking about interest rate risk and stuff like that. And certainly right now in an environment where people are predicting higher interest rates due to inflation and this and that, that it is very powerful to be able to lock in 30-year debt. I mean, that's actually an incredible edge. Massive win in the SFR category. Except fundamentally, I want to move into larger buildings.
Can I add something? Well, sorry, I thought you were done.
Yeah, no, I'm not. One, I want to move into larger buildings. And two, I would say is that my personal interest rate prediction is I do not think we'll get up to 5s. I think inflation is transitory. There you go. I'm joking.
I agree.
Because I lived in Asia. I've worked in supply chain. Like, I worked at a very high level. I worked in supply chain. We have an incredibly messed up supply chain that will sort itself
It'll
out.
get fixed.
I believe that is the cause of inflation. And so therefore, I think we'll be back in the 4s in 2 or 3 years.
And I also think, for me personally, it's very important to actually differentiate between different classes and stuff like this. So we're not talking either or. We're talking when multifamily, when residential. So it's not like one or another one.
Here's one thing I want to add. So Chelsea made the point earlier. We have $500,000 down, 25%. That equates to a $2 million multifamily unit, right? So on the surface, we all think, okay, $2 million, that's a commercial property. Does anybody here know, and I'll bet nobody does, what's the Denver metro area maximum county loan limit for a conventional loan on a 4-unit multifamily building?
Oh, I don't have a clue.
It's about
1.4?
Not quite. It's $1,375,000.
Oh, come on, Price is Right.
Which means
pretty close.
$1, Bob. But that means you could really buy about a $1.8 million property, put $450 some odd $1,000 down, and have a regular 30-year fixed rate loan at 4.5%. So
Yeah.
Jeff's question was terrific. Boy, $2 million seems like commercial. We got to refi it every 5 years
Yeah.
or every 10 years, but you actually don't because the loan limits increase as you have more units.
Yeah.
All right. And so I'd have to double check the numbers so we know right down to the penny what it is, but you could get bigger buildings and still get a conventional loan up to those higher loan amounts.
That is interesting because I mean, I'd say that exit cap rate risk is a boogeyman.
Mhm.
It's a real thing.
And-
or even having to refinance after
Right.
5 years. and
Why
you're
not
like,
take
"Oh,
advantage?
God."
The loan
Yeah.
you get from me is inflation protected, right? If
Yeah.
it's at 4.5%, it's always at 4.5%.
Yeah, I'm well
So-
aware. Yeah.
So
All
I
right.
think that was a great question.
Yeah, it was a
It is,
fabulous
and there's
question.
no right or wrong because I'm just gonna play counterpoint to this. Because if bigger commercials, which we're gonna get into one day, having a track record of owning commercial properties makes it easier to get future finance. At some point, you have to bridge that gap, commercial financing.
Yeah.
The better track record you have, the better it is to get the future commercial loan or eventually an agency debt loan on commercial.
Yeah.
The other thing is, how long do you think you'll own this next property? Because I've gone through shifts, I'm on this property forever. And I'm like, oh, I don't own this property forever. It's gonna be a few years before I trade up.
I would say if it was a multifamily, I would probably be following the standard 5 to 7 year life cycle.
So at
that's
that
the smart
point-
life cycle. Yeah.
You care a lot less about interest rates in 20 years.
Yeah. Except exit cap, right?
Yeah.
Because
Except
we like suddenly the property could snap back to being a 7 cap on the market simply because loan costs are so high in some sort of situation.
Mhm.
It's a possibility.
And there's pros and cons,
Yeah.
risk to everything.
But then there's also the term that if inflation is that bad, so rents have probably jumped dramatically. And so
It's all connected.
I have a lot
It
of
is.
thoughts on this,
Yeah.
and
It's
it's
all
not
connected.
the time for that. Yeah.
So since we have about 12 minutes left, any quick final thoughts there? I want to pivot to Ben's action plan.
No, this was a great discussion,
Cool.
and it's really good to know that I might be able to get a substantial portion of my cash in, more than the 217, because, I mean, that's a huge win. I don't think we need to reiterate what a win that would be.